Imagine turning $500,000 into $5 million while the rest of the market crawls along at 8% a year. What if the next trillion-dollar wealth transfer isn't in flashy tech memes, but in the invisible backbone powering AI? Data centers. Right now, in 2026, the data center infrastructure boom is exploding faster than most investors can react. Power demand is surging, hyperscalers are spending hundreds of billions, and supply constraints are creating massive opportunities. But most portfolios are completely missing it. Stick around, because by the end of this video, you'll have a clear blueprint to build your own data center growth portfolio. Why data centers are the new oil first? Understand the scale. In Q1 2026, the worldwide data center physical infrastructure market grew 28% year-over-year to $12 billion. That's the fifth straight quarter of over 20% growth, fueled by AI demand outstripping supply. Global data center investments are projected to reach massive figures, think $267 billion by the end of 2026, with capacity additions of tens of GW. By 2030, we're looking at nearly 100 GW of new capacity, effectively doubling the world's digital infrastructure. AI workloads are a huge driver, with data center electricity consumption expected to jump significantly in 2026. The problem? Power is the bottleneck. Hyperscalers like Microsoft, Amazon, Google, Meta, and Oracle are pouring hundreds of billions into CapEx. Projections for 2026 top $650 billion in some estimates, up massively year over year. This isn't optional, it's essential for training and inference at scale. If you're an investor with $500K, this creates a multi-year tailwind. Traditional portfolios miss it because it's boring infrastructure servers, cooling, power, networking, and the physical real estate. But boring wins in compounding. Equinix, EQIX, the premier global platform for digital infrastructure. Equinix stands out as the world's largest digital infrastructure company, operating a global platform of interconnected data centers. They don't just rent space, they provide critical interconnection services that let networks, clouds, and enterprises meet efficiently. This digital real estate moat is incredibly sticky. Q1 2026 delivered strong results. Total revenues reached $2.444 billion, up 10% year-over-year, 8% on a normalized constant currency basis. Monthly recurring revenue grew 10-12%. Operating income rose 26% to $577 million. Adjusted EBITDA hit a record $1.245 billion with an impressive 51% margin, up significantly. AFO per share showed solid double-digit growth, and they raised full-year 2026 guidance across revenue, EBITDA, and AFO. The highlight? Record Q1 annualized gross bookings of $378 million, the strongest first quarter ever, with roughly 60% tied to AI-related deployments. Annualized pre-sales added another $140 million, pushing the backlog to new highs. Interconnection revenue is accelerating, and churn remains low. Stabilized assets are delivering attractive 26% cash-on-cash returns. Valuation-wise, EQIX trades with a market cap over $100 billion. Trailing PE in the mid-60s to 70s, forward PE lower as growth compounds. Dividend yield around 1.92%. Analysts largely rate it buy, with targets suggesting 10-15% plus upside. Why it fits your growth portfolio? Global diversification: Americas, EMEA, APAC. Defensive characteristics from long-term contracts and direct AI tailwinds without pure hardware risk. In a $500K portfolio, a 20-25% position provides stability and steady compounding. Risks include high valuations compressing if growth slows, or CapEx-heavy periods pressuring free cash flow temporarily. But with record bookings and raised guidance, momentum is clearly on their side in 2026. Digital Realty, DLR, hyperscale specialist with enormous visibility. Digital Realty complements EQIX perfectly as a hyperscale-focused REIT. They excel at large-scale builds for the biggest cloud and AI players with a massive development pipeline and strong private capital partnerships. Q1 2026 performance was excellent, revenues around $1.6 billion, up 16% year-over-year. They signed bookings expected to generate $707 million in annualized GAAP-based rent at 100% share, $423 million at DLR's share, including the largest hyperscale lease in company history. Record backlog reached $1.8 billion, $1.0 billion at share, providing multi-year revenue visibility with commencements ramping in 2026-2028. Core FO per share hit $2.04, up meaningfully year-over-year, with positive renewal spreads around 5% cash. They raised full-year 2026 core FO guidance to $8.10. Occupancy trends are improving, interconnection is strong, and their private capital platform, including a new hyperscale fund, adds fee income and capital efficiency. Market cap in the $60B+ range. PE around 45-50x trailing, attractive relative to growth. Dividend yield near 2.8%. Wall Street targets often sit in the $215+ range, implying solid upside. In your portfolio, DLR brings higher hyperscale leverage and development upside. Pair it with EQIX for balanced REIT exposure. Strengths. Massive backlog de-risks growth, AI demand is broad-based. Watch risks like construction delays, interest rate sensitivity, or regional power issues. In 2026, their execution on large leases positions them for continued FO growth and potential dividend increases over time. Vertiv, VRT. The critical enabler for power and cooling in AI data centers, Vertiv, completes the trio by tackling the hottest technical challenges: power delivery and thermal management. AI servers generate enormous heat, making liquid cooling and efficient power systems non-negotiable. Vertiv is a leader here. Q1 2026 was outstanding, net sales $2.65 billion, up 30% reported and 23% organic. Operating profit rose over 50% with adjusted operating margins expanding 400+ basis points. Americas led with 44% organic growth. They raised full-year guidance significantly, expecting $13.514 billion in net sales, 29-31% organic, and adjusted EPS up over 50%. Order momentum remains strong, with robust pipelines for integrated solutions like prefabricated power and cooling modules. Backlogs support visibility well into future quarters. Liquid cooling adoption is accelerating as rack densities climb. Premium, with market cap over $100 and elevated PE reflecting 20-30% growth rates. Strong free cash flow generation and margin expansion support it. Analyst consensus is strong buy, with targets implying meaningful upside. Why 25-35% allocation in a 500K portfolio? Vertiv offers pure play growth torque to the infrastructure theme. It balances the steadier REITs with higher beta to AI spend. Risks, supply chain pressures, competition, or cyclical slowdowns in non-AI segments. In 2026, their raised guidance and focus on high-power AI deployments make it a standout compounder. Outlook remains bullish. All three companies raised guidance amid strong demand. The supercycle has years left as inference scales and new capacity comes online. Valuations are full but supported by earnings momentum. Risks, higher interest rates pressuring REITs, execution slips on CapEx, or AI hype cooling. Mitigate with position sizing, long horizon, and diversification. Equinix, Digital Realty, and Vertiv form a powerful trio for data center infrastructure exposure, combining stable cash flows, development scale, and critical tech to drive your portfolio from $500K toward $5 million. The real winners in AI will be the infrastructure owners and enablers. Subscribe for deeper dives, like my next video on AI power plays. Like and comment your allocation thoughts below. Start positioning today, the compounding window is open. See you soon.